analysis report on NBIS Group, NBIS. The title is NBIS Explodes plus 14%. Why you can't ignore this move, rocket. It's a very aggressive buy thesis after a big reversal. Let's just get right into it.
Yeah, I mean, the energy here is fantastic. It grabs you immediately. But to really land the punch, that claim, the one that the $22.5 billion market cap is a bargain multiple, we need to move that from just a bold statement to, a properly bulletproof argument.
So the ambition is fine. It's the foundation that's a bit shaky. It throws out these huge numbers. 437% year-over-year revenue, a $7 to $9 billion run rate target, but it kind of skips the hard part.
Exactly. It doesn't show the math. So to elevate the analysis report's credibility, the connection between those future revenue targets and the current valuation multiples, it just needs more rigorous justification.
Okay, so we need to bridge that gap. How do we model that kind of acceleration to make it feel, less like a guess and more like a forecast?
Well, you start with a reality check. You have a $7 billion ARR target, right?
Right.
So let's see the model. What's the required quarter-over-quarter growth rate to get from where they are now to that target in the next year?
Showing the actual acceleration needed.
You have to. It grounds the target. It shows whether it's, ambitious but possible or just pure fantasy.
That makes the internal math transparent. But what about the multiple itself? It positions NBIS in that hot AI infrastructure space.
Absolutely. The report brings up AI NeoCloud. It even mentions CoreWeave. So let's use that.
You mean a direct comparison?
A direct comparison. Explicitly compare NBIS's implied price-to-sales multiple, based on that $7 billion estimate, against the PS multiples of its actual peers. That's how you validate the bargain claim.
Without that, it's just a number you picked?
It's just a hopeful assumption. Yeah.
And what about that range, $7 to $9 billion? That's a $2 billion gap. That's a pretty big window.
It is, and it needs explaining. We need to clarify what assumptions on pricing power are baked into that high-end $9 billion goal.
Pricing power driven by the sold-out capacity they mentioned.
Exactly. Is that $9 billion just more volume at today's prices, or does it factor in significant margin expansion because their service is so scarce? Detailing that makes the whole thing feel so much more robust.
Okay, so if we can make the valuation case hold up, the next question, the one I'd be asking, is how are they going to pay for this? We're talking about massive, massive capital expenditure.
And that leads right to the next point. The report kind of waves away the risks. It briefly mentions fears over debt capex caused a sell-off, but that's it.
Right.
So introducing a structured section on significant risks would transform the report from a persuasive thesis into a robust, comprehensive analysis. You have to address the bear case head-on.
The report frames sold-out capacity as this incredibly bullish signal, and it is. But it's also a warning sign, isn't it? It means you have to spend an enormous amount of money just to meet the demand you already have.
That's the paradox. And the analysis it doesn't quantify it. It doesn't say how the capex will be financed or how they'll mitigate the very real risks of debt or dilution. It's a pretty big blind spot.
So the suggestion is to dedicate a whole section to it?
A specific, focused section. Address the primary financial risks of scaling an AI infrastructure company this fast. It actually builds trust, It shows you thought through the hurdles.
Okay, if you had to pick the two most critical risks that need to be quantified, what would they be?
First, the supply chain. The whole thesis is built on getting NVIDIA's Blackwell Ultra chips, what they call the most scarce hardware on the planet. The report has to clarify the risks of being so dependent on one supplier. What happens if NVIDIA's allocation changes, or if timelines slip? That's a huge potential choke point.
Yeah, it completely changes the conversation from can they sell it to can they even get it?
Precisely. And second, you have to detail the estimated capital expenditure. We need to move past a vague fear of debt and into some actual financial modeling.
And what does that modeling look like? What should it include?
It should discuss the potential impact on cash flow, on the debt load, and on the share structure.
You mean like secondary offerings?
Exactly. Acknowledge the possibility of secondary offerings to fund growth and model the dilution. For a stock like this, that kind of transparency isn't just nice to have, it's essential.
And I assume a stress test is needed? You can't just present the best case scenario.
You have to. Incorporate a sensitivity analysis. What's the downside if we hit a cyclical downturn in AI spending? How fast does that technical support at $75 completely fall apart?
A strong analysis should be able to withstand that kind of pressure test.
Right. It prepares the reader for the volatility that is almost certainly coming.
Okay, that makes sense. Let's shift gears to the technicals. The report really focuses on that big plus 14% day. calls it a volume-backed reversal that defended the $75 level.
And it was a powerful session. But the technical analysis could be strengthened by grounding that price action within a clearer, longer-term structural framework.
What do you mean by that?
Well, it relies on descriptions like the candle engulfed the previous losses, which is fine, but it's a bit anecdotal. It doesn't give you objective proof that this reversal has legs beyond just one day.
So we need to connect the short-term pop to the bigger picture. Assure the reader that the fear flush is over and this is a real sustained move.
Exactly. Is this a structural change in the chart or is it just some short covering? That's the key question a trader needs answered.
So with the stock closing around 89, what specific structural indicators could they use to make that case stronger?
Well, for one, specify its proximity to key long-term moving averages, the 50-day, the 200-day.
Okay.
Reclaiming a major moving average is a much more powerful signal that momentum has shifted than just getting back above $80, which is more of a psychological level.
It's a more durable confirmation.
A much more durable confirmation, yeah.
The report does note the stock is still way off its all-time high of $141. The path to their 150 target is, it's a long one.
And that's a huge opportunity for context. The analysis needs to identify the specific, historical resistance levels between, say, 100 and 141 that NBIS has to clear.
The old breakdown points.
The structural hurdles. Laying out that roadmap validates the reversal and gives traders key levels to watch. It makes the entire piece more useful.
And what about the call to action? To make it truly actionable?
Let's make it definitive. Detail the specific price action that signals the start of a new momentum leg. Don't just say, watch for a retest.
So something more concrete.
Way more concrete. For instance, specify that a break and hold above the $100 psychological barrier would be the real signal, or maybe confirmation that $85 support holds on a retest. Making the criteria explicit just enhances the utility of the whole report.
Okay, that brings us to the end.